Hello everyone and a warm welcome to the Morgan Direct online investment webinar. My name is Bobo. I'm a client advisor with the Hong Kong Direct business. Today I'm excited to be joined by our global market strategist Marcella. Over the next 30 minutes or so, Marcella and I will be sharing the latest market outlook for the second half of the year. We'll also talk about how to navigate volatility in AI-related investment themes to help you take proactive approach in managing your fund portfolio. We'll also show you how the Morgan Direct platform can help you save investment costs and maximize your portfolio returns. So Marcella, in our last live session, we discussed how geopolitics impacted the investment markets for the first half of the year. Now, as we step into H2, I think the landscape is shifting a bit, especially with a new Fed chair in office. So how are we looking at the Fed's interest rate policy for the rest of the year?
Yeah, hi everyone and hi Bobo. And so today's market is full of headlines, like what you said, the new Fed market is expecting, eventually he'll turn dovish under Trump administration and will likely be cutting rates. AI may transform everything overnight. Market cap tech is like the only way to invest in innovation. And Asia, it's just a supply chain story. But markets rarely reward investors for chasing these headlines. Markets reward investors for seeing the gap between those headlines and the reality. So the theme today is mind the gap and trade the gap. Mind the gap means recognizing where the narrative is too simplistic and not just listening to what people say. It means taking a clear look at how far the story is from the reality before you step in. So we're here in Hong Kong, we hear all the time when you're taking MTR. I'm sure a lot of you just got out of work and probably are on the MTR watching our YouTube live right now. You might hear mind the gap all the time. And similarly, if you hear the mind the gap, you don't step onto the platform just because someone tells you it's fine. You should look at the gap first by yourself. And trade the gap means that once you can see that gap clearly, if the market's pricing has drifted too far in one direction, that gap is actually where the real opportunities can be. And in our view, AI sits at the center of all three gaps that we're going to discuss today: the policy gap, the productivity gap, and the market leadership gap. And the first gap is the policy gap. So the headline may suggest, the Federal Reserve is about to turn dovish given the political pressure from the Trump administration. But the reality is the Fed actually has room to be patient, and we believe neither a cut nor a hike is necessary at this stage. Yes, we see softer June consumer price index back to 3.5% from the May peak of 4.2%, which should buy the Fed some time and reduces near-term tightening concerns. But if you listen to recent Fed officials' comments, the tone still carries a slightly tightening bias. The key point is the market should not confuse less need to hike with urgent need to ease right away. The Fed can still be patient, but patience is not the same thing as dovishness. Because oil prices, geopolitics, and still firm labor markets mean the Fed may stay on hold longer than what you or the markets expect. And the risk of further tightening has not fully disappeared either. And there's one more new variable: tariffs. The US had announced a 50% tariff on goods exported from Canada, taking effect in 30 days. And what surprised markets is that even goods under the USMCA framework, which is US-Mexico-Canada agreement framework, were not exempted. Separately, the US last week imposed 25% tariffs on thousands of Brazilian products, and that actually went effective yesterday. I read is that the administration is now walking a very tight rope, trying to raise tariff revenue while also trying to contain inflation pressures. But then if higher imports costs are passed through to retail prices, that could actually push inflation high again, weigh on consumer sentiment, and complicate the rates outlook. We do not expect overall tariff rates to return to close to 30% peak as we saw back in April 8th, 2025. But then from the current close to 11%, the direction over the coming months is still more likely gradually higher. And in other words, the risk of renewed tightening is not fully off the table. And even though the market continues to price in more than one hike by year end, our base case is no policy rate change for the rest of the year, which means no hike and no cut. And in particular, a return to the 2023 to 2024 peak about 5% is still highly unlikely. So how to trade the gap? Stay invested, that's key, but do not build portfolios around a sudden return to ultra-easing policy or a sudden shift to ultra-tight policy, which are those pretty two extreme scenarios. And for you guys, for investors, for YouTube Live audience, fewer rate surprises can support risk assets like equities and credit. But the real opportunity is not simply betting on lower or higher rates. It is to identify companies and sectors that can grow even if policy stays unchanged for longer. That matters for AI, which is the theme for today, because AI is highly capital intensive. And a stable rate environment helps. But higher for longer discipline forces the market to focus on a more fundamental question, which is which AI companies can convert investment and spending into real revenues, improving margins, and ultimately sustainable cash flow.
Yeah, with the interest rate expected to stay stable and the latest US employment indicators still looking quite solid, are we constructive on the outlook for US growth?
Indeed. In terms of the Fed's dual mandate, besides inflation, the other core pillar that everyone should not be neglecting is the labor market. So like you asked just now, recent job gains have indeed come in stronger than expected. But we still see signs of cooling in hiring because labor supply remains tight, and at the same time, productivity is improving. So companies may not need to add headcount at the same pace as before. This combination can keep the labor market resilient. We saw unemployment staying broadly stable, while wage growth remains relatively contained, which help reduce the risk of wage-driven inflation. And here comes the second gap. So after the first gap about policy gap, the second gap is the labor gap. So the headline may suggest, like we talked about just now, the labor market is still firm. But the reality is the economy cannot rely indefinitely on growth driven only by adding more workers. Labor force growth is slowing. And if you see from this chart on the top left, we see over the next decade, demographics become a bigger constraint. In particular, as labor force growth slows, sustaining growth can no longer rely primarily on an expanding working age population. As you see, labor force growth slows towards, if not close to, the contractionary zone by the furthest bar by 2026 to 2035. The drivers include like tighter immigration policy, which slows immigrant growth, while the contribution from native-born population growth is also declining. And in other words, future economic growth will face demographic headwinds, while we hope technology can help provide some sort of tailwinds that help offset them. And if we look at the bottom left chart, we see that it shows that a greater share of capital spending is likely to be directed towards intellectual property and R&D, pointing to a more knowledge-based and technology-driven investment cycle. And on the right, we see that with labor force growth constrained, sustaining real GDP growth, like real economic growth, will depend much more on productivity gains, innovation, and also capital deepening, and not simply on adding more workers. So that means the growth model has to change. And if the economy cannot rely as much on labor force expansion, it actually needs each worker to produce more by doing more, faster, and also more efficiently. That is why productivity, capital deepening, intellectual property, and R&D matters so much. And this is the macro reason why AI matters. AI is actually not just a technology story. It may be one answer to the demographic growth gap. But how do we trade this gap? So we should look for technologies and companies that help the economy produce more with fewer workers. It's like being in the restaurant business. If you can't find more chefs to help you cook, you upgrade the kitchen, right? Improve ordering systems and optimize processes, trying to use better tools and better methods to try and serve the same crowd. And how can this be achieved? There is growing consensus that AI could actually become the next general purpose technology, comparable to back a long time ago with the steam engine, electricity, or even computer. The potential productivity uplift could be meaningful, but markets often compress the timeline and assume the impact will be very immediate. So here comes the third gap, which is the productivity gap. Headline may suggest, AI will immediately boost productivity and immediately reshape jobs. But with history, it shows that the reality may be that major technologies rarely make the whole economy faster overnight. Like the electric motor and the PC took many years, close to like 15 to 20 years, before they truly changed workflows and business models. And only then did the gains show up clearly in economy-wide productivity data. So AI may actually follow a similar path. The upside is significant, but the rollout is likely to be phased and uneven, with some industries moving faster, some slower, some companies benefiting much more, while others may struggle to keep up. So we acknowledge the upside is meaningful, but the timing of a clear macro-level productivity acceleration remains uncertain. So like I mentioned just now, past general-purpose technologies like the electric motor and the PC took 15 to 20 years to generate a more visible productivity step up. So productivity gains actually often arrive with long and uneven lags rather than immediately after technology is introduced. And at the same time, with this slow-growing labor force, productivity becomes even more critical. It's increasingly the core engine for economic growth, corporate revenue growth, and hopefully also creating improvements in our living standards. And here in Hong Kong, where we see hiring is hard and where we always hear wages are expensive is becoming the norm, whether companies can actually use technology to lift efficiency directly affects their cost base, service quality, and profitability.
When it comes to AI, I think it's hard to ignore the headlines, right, claiming that AI-driven productivity will then replace human labor. So in the long term, is AI really going to put a lot of people out of work?
That's a lot of audience concern all the time as well. But so far, research shows that AI has not had a material impact on the overall job market. But exposure varies dramatically across occupations. So we do want to emphasize one point, that the AI opportunity is not just about how capable all the models are. It's about whether companies are willing and able to redesign the workflows. AI is unlikely to affect every job in the same way too. Some tasks will be automated, some roles will be redefined, and new roles will also re-emerge. And the biggest challenge is training and transition, trying to reskill people from old skills to new ones, especially for working groups whose tasks overlap more with what AI can do. So even if AI drives productivity improvements, it will not happen everywhere at the same time. There will be fast and slow adopters, and there will be widening dispersion between winners and laggards. And so which leads to the next investment question you may ask. Where has the market already priced in too much optimism, and where are the true beneficiaries still underappreciated and underpriced?
Yes, thanks, Marcella. If I could just move from the broader AI outlook into specific AI investment themes, I think most investors would immediately think of the Mag 7s, so those US tech giants. How are we thinking about their investment potentials right now?
So in terms of Mag 7, the market always talks about them as just one big chunk, one big block. But that's mostly a matter of convenience. In reality, those are 7 companies spanning very different industries, from e-commerce, cloud, advertising, consumer devices, software, semiconductors, and autos. And their AI exposure is actually not the same too. And their ability to monetize AI is also different. And that matters because the market is moving from phase 1 of the AI cycle to phase 2. So what's phase 1 and phase 2? Phase 1 is, everyone's just excited with more compute. That was already enough to excite investors and the market. But now we're more like into phase 2, where investors are asking much more sophisticated and practical questions. What is the return on that compute? What is the return on investment? And is AI spending actually converting into real revenue, margins, and free cash flow? There are sayings that Mag 7 right now is called lag 7. So from M to Mag, from Mag to like lagging. So to lag 7, we see that year to date, performance dispersion has become very clear, with 3 names that are negative, and only 3 out of the 7 outperforming the S&P 500, which is up about 10% year to date. In other words, the Mag 7 are no longer magnificent in a way that they're moving as one, with the market is becoming more stock selective and actually more rational in picking the companies. And overall, AI remains a structural investment theme, but leadership is rotating also within the theme. And the opportunity set is broadening outwards, broadening out from the core to the next layer. So in the US, the AI story is still anchored around a few key questions. Hyperscaler capital expenditure, the CapEx, frontier model capability, and the fact that the monetization path is still rather uncertain. And importantly, investors are still being relatively rational about hyperscalers, like I mentioned just now. They recognize AI as a long-term trend, but they also keep a healthy degree of skepticism, pressing on whether the CapEx is actually worth it, when return on investment will show up, and how the cash flow pressure will be managed. And our view is that the AI cycle is still in an adoption phase, moving from pilots to scaling capacity to real deployment, and hasn't fully reached the broad monetization stage just yet. This phase can absolutely create opportunities for hyperscalers, but the payoff will not be evenly distributed. Across different model approaches and application pathways, revenues and monetization speed are likely to be, like just now what we mentioned, uneven and highly differentiated. And then a lot of you may be asking this question as well when you read the daily news. So is AI a bubble? It's true that valuations are higher, CapEx is enormous, and expectations are demanding. But so far, it does not look like a simple replay of past bubbles. Because from our analysis, we see that hyperscaler balance sheets are generally still healthier, model capability continues to improve, and hardware supply bottlenecks remain real. So we should draw the right conclusion as being not just AI is definitely a bubble, or AI will only go up. The better conclusion is AI is becoming more fundamentally driven and more selective, and the market is increasingly choosing and picking. And most importantly, the market's focus is rotating and broadening out from just the AI spenders, which are the hyperscalers, the companies investing heavily, to AI earners, the companies that can actually make money from the AI wave. And now this is where it's important to mind the gap between the headline and the reality, because the scrutiny of these AI trade remains healthy from our point of view. But so far, the most key thing is that the fundamentals are standing up to it as well. So demand is compounding, the strongest balance sheets are funding the build, and the companies supplying AI infrastructure are thriving. And whether the biggest spenders earn an attractive return remains to be seen, also from the upcoming earnings season, while the economics of AI services are still taking shape, which could keep markets quite volatile. But turning defensive too early also carries its own risk. So to all of you, trade the gap with an active approach, one that appreciates how these bottlenecks can evolve and spreads exposure across the layers of the value chain, so that your portfolio can stay invested while riding out the swings along the way. And that naturally brings us to this geography gap. In the previous slide, we see that the US may dominate this AI narrative, but Asia actually owns much of the AI infrastructure physical reality. And so this geography gap, which is the fifth gap, with the headline suggesting that, investing in AI means just buying the US mega-cap technology. But in reality, for AI to actually run at scale, much of the enabling hardware and supply chain sits here in Asia, with chips, memory, high bandwidth memory chips, servers, equipment, materials, and manufacturing. So how do we trade the gap? We should diversify AI exposure across regions, so not just focus in the US, but also broaden out to Asia and also across the value chain, focusing on areas where valuations look more attractive and when earnings expectations have more room to be revised upwards. So put simply, the US dominates the AI software narrative with frontier models, hyperscalers, and also cloud platforms. But making AI work in the real world requires a huge build out of like physical infrastructure, and Asia is a critical part of that. And as long as AI CapEx continues, demand for all these high bandwidth memory chips, advanced chips, servers, equipment, components does not suddenly disappear just because US mega cap valuation correct or experience any pullback.
I see the correction is also outside the US. Market pullbacks have seen recently across Asia tech sectors as well. How do we interpret this move?
Yeah, so very rightly said, we saw in Korea the past few weeks, we said the Kospi, as of latest, it's close to 25% below its June 19th peak after very highly volatile move. But the key is that Korea's fundamentals still look broadly solid. So we view it more as a positioning-driven normalization more than any change in fundamentals. And that's key. We see that the initial pullback was typical rotation. Then all these leverage ETFs and also hedge fund de-risking amplified it. According to our investment bank research, it suggests the ETF unwind is close to 75% complete. And hedge fund deleveraging is already over 50% complete. So the forced flow headwind should diminish. And stepping back, the multi-year AI and still robust CapEx cycle alongside confidence improvements keeps us constructive on Korea hardware and also equities. And the market should gradually absorb those unwinds and re-anchor to the fundamentals once forced selling fades. And if we give a simple ranking of Asia AI exposure based on strength of benefit and earnings visibility, we will continue to stay constructive on Korea as well, because it's like the most balanced and in our view amongst the most direct beneficiaries. The strength is in high bandwidth memory chips. And if global AI CapEx remains elevated, demand flows flew relatively directly into Korea. So earnings visibility is also comparatively higher. And other than Korea, Taiwan is also one of the most direct, hard-to-substitute hardware beneficiary. Its strength lies in advanced chips, foundry, and the AI server supply chain. So when AI CapEx is still rising and robust, Taiwan is often on the front line to be benefited. And don't forget China. It's a different pathway than the US. It's more about localization and cost efficiency. Its strength comes through accelerating domestic adoption, enterprise applications, and supply chain self-reliance, and also policy support. So more of an application diffusion beneficiary set. And last but not least, Japan. More of an upstream enabling story, potentially slower cadence, but steady. Its strength is in equipment and materials, and the critical foundation that supports the whole AI ecosystem. And the benefit can be more indirect, but actually often more durable. So looking ahead, as investors, we should look a few steps ahead. We think that the next stage of AI investment may evolve from AI earners, the hardware and the hard tech, towards AI users. So early on, the market rewarded the AI hyperscalers, the AI spenders. So the companies building the compute and the tools. Then the focus broadened to the suppliers of the build-out. So the ones we mentioned just now, the AI earners in the supply chain and infrastructure. And from here onwards, the opportunity set can widen further into the real economy. Companies using AI to lift productivity, lower costs, and improve returns across industries like manufacturing, logistics, healthcare, design, research, and services. And just give you a more concrete example where this broadening may show up. First of all, industrial acceleration, like the robotics and autonomous driving, can lift productivity across manufacturing, construction, and logistics. And research and development acceleration as well. AI can speed discovery and development in like life sciences, chemical engineering, and industrial design. So as these sectors begin to deliver like real breakthrough outputs like new therapies, better equipment, more efficient processes, capital will start rotating from all these supply chain and infrastructure winners, like the AI earners we talked about, towards those companies that use AI tools to deliver measurable efficiency gains, which are the AI users. And that kind of rotation typically favors active management and deeper fundamental stock selection. So give you an example, as we're here based in Hong Kong. So once the tools mature, the winners, with the restaurant analogy just now, the winners are not only the companies selling kitchen equipment anymore. Often the winners are the restaurants and businesses that use the new equipment and systems to serve faster, improve quality, and run more profitably. And that's where opportunities broaden from a single sector into many sectors and regions. So hopefully the core message that I can send across is that diversification does not mean stepping away from AI, or some investors may be more extreme of saying, oh, anti-AI. Diversification is how you stay effectively exposed as the AI leadership rotates. From phase one, the AI spenders, the hyperscalers, cloud platforms, model owners, to phase two, the AI earners on semiconductors, memory chips, servers, power, components, infrastructure, to phase three, the AI users, the companies across industries using AI to raise productivity, cut costs, and improve returns. So today we've walked through several gaps: policy, labor and productivity, rotation within the AI theme, and just now the last one on geographic gaps. And just like what we hear on the MTR, or where you are right now on MTR, mind the gap. Investing is the same thing. Do not just follow the headline. Look at the gap between reality and pricing, and once you see it clearly, you can step in with conviction and trade the gap.
Thank you, Marcella, for cutting through all the headlines and giving us actionable insights for active asset allocation. To quickly wrap up our key takeaways today, first, we expect the Fed to keep interest rates stable in the second half of the year, which favors risk assets such as equities. Second, while AI is definitely boosting productivity and playing a critical role in long-term economic growth, our focus when picking AI investments should shift away from AI spenders, so companies investing heavily into computing power. Rather, we should look at AI earners and AI users, companies with real monetization power in the AI space. Third, Asia Tech. We think the sector still play a vital role in both infrastructure and hardware, with more attractive valuation following the recent market pullbacks. Last but not least, when it comes to investing, performance matters, but keeping your costs down is just as important to you. That's why the Morgan Direct platform has launched 6 exclusive digital share class, offering you lower management fees and 0 subscription fees. These share classes help you save investment costs and thus drive better returns. These digital share classes are for monthly investment plans. Their management fee are only 75 bips per year, so that's literally half the fee of the other share class in the same fund. For example, if you invest 10,000 Hong Kong dollar a month over 10 years, you save 45,000 Hong Kong dollars in management fees alone. Better yet, the subscription fee for these share classes is fully waived. So compared to the standard 2% fee on most online platforms, a 10,000 monthly investment plan for 10 years will save you another 24,000 Hong Kong dollars. So put together, this setup will save you nearly 17,000 Hong Kong dollar in total costs to help drive better returns. So how do we get started? These digital share classes are available on the Morgan Direct platform, covering 6 different Asia equity strategies, including the Asia Tech strategies. For existing clients, simply search the keyword digital in the monthly investment setup page to find out all eligible funds on our platform. You can start a monthly plan with just 1,000 Hong Kong dollar, making it very flexible. Thank you once again for joining our online investment webinar today. We hope you find our insights helpful, and we look forward to seeing you next time. Goodbye.